but not the least of the...
About 24 hours ahead of the Monetary Policy Committee meeting, the Minister of Finance told captains of industries at a presidential business meeting at the State House in Abuja that lower interest rates are expected in a recession.
Interest rate rise, I think, during a recession needs to be relooked at, and I'm very sure that the Monetary Policy Committee, who are meeting this week, will be looking at that. In a recession, we need to reduce the cost of borrowing.
But dousing the high expectations of business concerns over lower rates, the governor of the central bank announced a retention of all monetary instruments at the current levels before the recession set in.
All 10 Monetary Policy Committee members voted as follows. 1. Retain the MPR at 14%. Retain the CRR at 22.5%. Retain the liquidity ratio at 30%, and retain the asymmetric window at plus 200 and minus 500 basis points around the MPR.
He says previous rate cuts put pressure on the economy as lower rates fueled the demand for forex. He also says making provisions for governments to borrow at lower rates might stimulate demands, but also create a risk of very high demand with much less supply.
If you borrow at lower rates to stimulate spending, what that does is that, well, yes, it stimulates demand for goods. But when you stimulate demand for goods by providing cash or money to be spent without taking action to boost industrial capacity, taking actions to boost manufacturing output, what happens is that you will see a situation where you have too much money chasing too few goods, which will also worsen the inflationary conditions that we are now.
The expectations at this unusual economic times is for fiscal policy to harmonize with monetary policy and also for monetary policy rate to move closer to the inflation. But the central bank governor says lower rates are not the immediate solution. Omelogo, Nadi Channels Television News.
And the challenges confronting the...
This government is trying to spend its way out of trouble, and that spending, much of it, is being borrowed. So if you increase the interest rate, it increases our costs of debt service. So in an ideal world, I would need lower interest rates. I think business, when you're in a recession, typically you cut interest rates to stimulate activity. So we would love to see the MPC consider how they can help us lower interest rates, because we think in terms of business activity that will deliver greater results to Nigeria. And I do understand what they were trying to do, which was they're trying to manage inflation. But if you actually look at the structural nature of the inflation, it's unlikely to really respond to monetary policy initiatives. It's structural inflation that's caused largely by the pass-through of costs from the exchange rate movement.
So there you see the positions of the CBN governor and the Minister of Finance, those responsible for the monetary and the fiscal policies. So it doesn't appear they are disagreeing to agree or disagreeing altogether in terms of how to get us out of this recession. Well, that's what we're focusing on next today on the program. And let's take you to Abuja. Markwe?
Oh, thank you, Chamberlain. We do have with us the Director, Monetary Policy Department at the Central Bank of Nigeria, Mr. Moses Chule. You're welcome to Sunrise Daily, sir.
It's a pleasure. Thank you so much.
Well, we have seen the Monetary Policy Committee come out with the interest rates, and you already know the background. There had been a request, or is it some push from the Minister of Finance asking for lower interest rate cuts, even though some analysts were not quite sure that was going to happen. Eventually, the MPC did not go with the request of the minister, and it was seen that the CBN governor has been speaking on that. What more do we have to say to that?
No, I'm not too sure it was a request by the Honorable Minister of Finance to the Monetary Policy Committee to cut rates. Things don't happen like that. The Honorable Minister expressed the desire that if it were possible for the MPC to reduce rates, now the MPC had to look at the fundamentals. I think we need to look at the fact that there's no quick fix in a recession. A mere reduction in interest rate, you're not doing anything to the economy. Nothing, virtually nothing, if you just simply go about reducing interest rate. I give you an example. If you look at Japan, interest rates are in the region of less than 2%. They've been in recession for more than 10 years, and interest rates are as low as that. In fact, in the UK, the Bank of England just reduced interest rate to 0.25% from 0.5%, and still nothing is happening. In the European area, I mean, the European Central Bank has also reduced interest rate to the region of about 1%. Again, nothing is happening. So the solution does not lie in the reduction in interest rate. You must get that clear, very clear. We are not just in a recession, we're in a stagflation. If we were merely in a recession, then you couldn't just go about, say, okay, we could spend our way out of the recession, but we're in a stagflation, where you have growth has dropped precipitously to negative, and you have prices rising. So you have to really balance. The policy mix has to be thorough, very, very comprehensive, and well thought out. It is insufficient for the Monetary Policy Committee to just meet and say we are reducing interest rate to address a stagflation. Stagflation is a very complex economic situation. In the life of the United States, for instance, they've had, I think, about two or so. One was in the 1930s, it was great. The second was in the 1970s. And what was the policy mix? The policy mix wasn't just left with the central bank, but when the Fed decided to provide the lead in the 1970s, we saw exactly what happened. What happened? The Fed just felt this was strictly a monetary policy phenomenon. And that was when we began to first, the world began to be confronted with the lexicon stagflation. And monetary policy felt it was strictly a monetary policy situation. So the Fed under Paul Volcker went ahead to reduce interest rates. What happened with the reduction in interest rate? And then people just, the Fed went ahead to increase interest rate. The increase in interest rate led to higher borrowing.
Higher cost of borrowing.
Higher cost of borrowing. The higher cost of borrowing led to higher debt levels. And what did we have? We ended up with a global crisis, the debt crisis, where countries start to build a very huge debt stock.
Which is what
globally.
Which is essentially what the Minister of Finance was saying. She was saying that if the CBN is able to reduce the rate, that the cost of borrowing, especially on the part of government, becomes reduced, and as such, they don't pay so much on debt servicing.
That's not to my opinion, what the policy direction should be now, because interest rates have been reduced in this economy to 6%. The NPR was 6%. Government was borrowing. The NPR had risen to more than what it is now. Government has always been borrowing. The solution lies in monetary policy, fiscal policy, trade policy, budget policy, sitting together in a retreat to fashion out comprehensively what is going to be the policy response. You can't clap with one hand. Even if we reduce interest rate in this economy today to 2%, and the banking system does not respond to your reduction in interest rates, what happens there? You've lost the anchor, completely lost the anchor. And what we've seen happen in this economy is that The central bank has reduced interest rates several times. The banking system has not responded. Interest rates have not responded, going downwards. The reason is simple.